for one more minute to allow people to come into this briefing. My name is John Turner. I am one of the directors of the Long Run Institute, and I'm also the head of Queen's Management School. So welcome. So if you're dialing in from North America, good morning. If you're dialing in from Europe, good afternoon. And if you're dialing in from Belfast, what are you doing listening to this? You should be on the beach, because this is the only week in the year that we're going to get sunny weather. So welcome. This briefing is being co-hosted with the William J. Clinton Leadership Institute, which is part of Queen's Management School. So the Long Run Institute is a North Atlantic collaboration between the Queen's University Centre for Economic History and the Toronto-based Signal Influence. And the LRI brings an historical perspective to the grand challenges facing businesses and governments. Insight from hindsight. The William J. Clinton Leadership Institute is the executive education wing of Queen's Management School, which has a mission influenced by President Clinton himself of shaping leaders for a better world. I want to thank Sue Burns and Rachel Lauder from the Leadership Institute for all their help with the organisation of today's event. Something peculiar has been happening in financial markets. Despite the worst pandemic in a century, stock markets have been booming. The prices of technology stocks have soared. There's been a boom in SPACs, or these blank check companies. Cryptocurrencies such as Bitcoin have soared in value and fluctuated on the pronouncements of Elon Musk. Even Dogecoin, a cryptocurrency founded as a joke, has enjoyed an impressive hike in value over the past year. Added to that, house prices on both sides of the Atlantic have started to increase quite substantially. What's going on? Why is this happening? Are we living through a bubble? Have people gone mad? What are the implications of this for the financial system and for central banks? These are just some of the questions that we will address in this LRI briefing, using a long-run perspective to help shape our thinking about these developments. We want to develop some insight from hindsight and from a very wide range of perspectives. So to help us do this today, I am delighted to introduce four very well qualified individuals. So bringing us the central banker perspective today is Rebecca Stewart, who has worked as an economist for the Central Bank of Ireland since before the global financial crisis, and is currently a researcher at the University of Neuchâtel in Switzerland. Rebecca is also an honorary professor of practice at Queen's Management School. So you're very welcome, Rebecca. Bringing us the investor perspective is Jamie Catherwood, who is an associate at O'Shaughnessy Asset Management in Stamford, Connecticut. Jamie is better known as the finance history guy, and he's been working on educating investors in the US and further afield on the need to learn from the past. You can find him on Twitter and online at Investor Amnesia. Bringing us then the risk management perspective is Sonia Baxendale, who has been the president of the Global Risk Institute in Toronto since 2019. Sonia has a wealth of experience in the financial services sector, and she'll help us today understand the risk implications of the machinations in today's financial markets. So welcome to Jamie and Sonia. Finally, bringing us the perspective from the Academy is Will Quinn, who is a lecturer in finance at Queen's Management School. Will has recently co-authored a book on the history of bubbles entitled Boom and Bust, A Global History of Financial Bubbles. His book was chosen as one of the Financial Times economics books of 2020. So welcome to you also, Will. So welcome to the audience. I'm going to suggest to you, some people have already fed us through questions that I'll be posing to the panel. But if you have any questions, just use the Q&A function on Zoom and type in your question, and I'll keep an eye on those, and I'll pepper those questions into our conversation today. So we have three segments that we're going to focus on today. First of all, we're going to think about what's been happening in financial markets and the implications of that. We then want to have a segment on cryptocurrencies, because again, that's become something that's very popular with investors today. And then the third segment of our discussion is really going to look at the pandemic and then the economic cost and the effects of the huge monetary around the globe have been experiencing. So let's start thinking about what's been happening in financial markets. I'm going to start with Jamie. Jamie, what's been going on in financial markets since the onset of the pandemic? Could you maybe sum that up for us? And have we been here before?
I can certainly try to sum it up. There's a lot to sum up. And actually to that kind of point, I feel like it's been, with COVID lockdowns and everything, it feels like it's been 5 years, even though it's obviously been much shorter than that. But it almost seems like you can't really sum up what's happened in markets in just kind of one linear narrative, because there's been so many mini bubbles and episodes that have occurred within it. You had NFT craze, you had the SPAC boom, which now seems like a distant memory. Then you had a wave of IPOs. And you've had these kind of narrative driven rallies and headlines that dominate markets at different stages. Obviously in February, I think it was 19th, 2020, we had the market peak. And then from there, in short order, the markets quickly fell some 50% in the US. And then from there, as everyone kind of started working from home, we know what happened when, in the US at least, stimulus checks started being sent out and suddenly people were stuck at home, no sports to watch, no other kind of sports to gamble on, but suddenly they had excess cash in their accounts because the government had sent out $1,200 stimulus checks. And so a lot of people turned to the markets because there was not much else to do and there was a way to make money. And it was interesting to see how that kind of coincided with the bottom of the market on March 23rd. And then, as you alluded to, this kind of just massive rally since then, despite the fact that we're continuing to live through a pandemic. And I think, and I've written about before, that Warren Buffett has talked about this concept of the 3 I's, where you have the innovator and then the imitator and then the idiot who ruins something for everyone. And I feel like this progression kind of has played out a few different times during COVID in the markets, but most notably with the kind of electric vehicle craze during the earlier part of the pandemic, where around that same time where a lot of kind of first-time investors or traders, whatever you want to call them, came into the market using Robinhood and using their stimulus checks to invest. That was the same time where Tesla, a very familiar name, even if you don't know anything about markets, people know who Elon Musk is, et cetera, the sexy technology-ish company. It was up, I think, by August, it was up something like 300% for the year. Don't quote me for that, but it's hundreds of percent up. And so these kind of first-time traders who didn't know much about investing, but saw a familiar brand with a cool kind of marketing component just soar, they could buy that and they were just making tons of money. So suddenly investing seemed easy. And so then you had all these kind of other EV companies through SPAC deals starting to go public or announced plans to go public. And then people who had missed out on that Tesla rally started thinking, oh, well, this could be the next Tesla. And so getting in on that. And so ironically, sharing the same name with Nikola Tesla, Nikola Motors goes public in June, and then that goes up like 80%, despite the fact that it only had $36,000 in sales in its first quarterly report. And those were from installing solar panels on the chairman's ranch in New Mexico. And we all know what happened there. And fairly quickly, it became apparent that they were potentially misleading investors with some of their presentations of trucks rolling down hills instead of propelling themselves with an engine. But I think it showed this kind of innovator Tesla and then wave of SPAC deals where it seemed like every 2 days there was a new EV company going public or announcing a SPAC deal. And some of them in recent months have come out. I think like Lordstown Motors was one where there's probes from regulators into what they told shareholders in terms of the sales and orders they had, et cetera. But I think that kind of wave has played out a few times where that kind of innovator, imitator, idiot progression, you've seen it in crypto when Bitcoin kind of rallied. Suddenly you had then knock-on rallies in Dogecoin and other kind of altcoins or smaller coins. And people are just always trying to find that next kind of sexy investment because they might have missed out on the first. And I think just in general during the pandemic, because nobody really knew how to evaluate a company's prospects when we didn't really know what the future looked like. with a lack of fundamentals, everybody just attached themselves to narratives. And so I think narrative-driven investing became kind of dominant, I guess, force in markets during COVID, because it's hard to know what sales are going to look like in 2 quarters if you don't know what the world's going to look like in 2 quarters.
So Jamie, have we seen this type of thing before in terms of, novice investors, new tech, the progression towards the fraudulent type companies? Have we seen this? Is this something that's just happened this time and we've never seen this before? Or have we seen this in history before?
Definitely seen it in history. My favorite example is the 1690s London IPO kind of mania and technology bubble, which is also funny because it's a 90s tech bubble. That's not the 1990s. And in that case, there was a really successful treasure hunt. And this guy went and found treasure. I think he found like 32 tons of treasure. But his backers in London, who had financed his trip, they had formed a small company. And when he returned, their return was like 10,000%. I think they got £5,000 for every 100 pounds they put in. And so suddenly all these other London investors, they wanted to replicate that success. And so there's this explosion in diving technology companies, which theoretically would allow you to, the whole point was it'll let you breathe underwater faster, which can increase the odds that you find treasure if you can hunt longer underwater. And so all of these companies floated. I think there was like a 6 times increase in the number of patents related to sea and engine technology, in quotes. And all of them were not all of them were fraudulent, but none of them replicated the success. And so it was just a lot of them were fraudulent. So again, that kind of 3 eyes progression. Mm-hmm. But a ton of new traders and investors came into the markets. But I think of the 240 companies that were trading in London in 1694, by 1697, 70% of them had been wiped out. So it was carnage in the markets.
Yeah. So we have been here before.
Certainly.
So thank you, Jamie. So Will, you've written the book on the history of bubbles. Do you see any parallels with what Jamie has described in terms of what's been happening in financial markets? Do you see any parallels, between today and past bubbles?
Yeah, thanks, John. So any parallels between today and past bubbles? Well, we looked at 300 years of financial markets, looking at times when there were a lot of financial bubbles, but also times when there weren't. And our big conclusion was that bubbles don't occur randomly. They don't occur cyclically, which I think is something that a lot of people believe. You have long stretches when there are no bubbles, and then stretches where there are a lot. So bubbles happen under very specific circumstances. They happen whenever assets are highly marketable and highly liquid and are becoming more marketable and liquid. So if there's the removal of legal restrictions that make it easier to buy and sell stocks, if there are falling transaction costs, if there's new technology that means you can buy and sell assets at home or on your phone, this tends to result or be one of the conditions that leads to the development of bubbles. The other one is abundant money, so lots of cash in the economy. Low interest rates, a low return on traditional assets tends to pull money into what Jamie has just called like narrative-driven investment, where people are looking for something else. And the third condition is speculative investing, where people are tending to buy assets because they think the price is going to go up without necessarily caring about its underlying cash flows, what the asset actually is or what it does, how much money it's expected to generate, or really anything else. And this is typically started by an initial increase in the price, which attracts these investors. You're earning 1 or 2% a year on your safe investments, and your friend is doubling his money in the space of a month. This is the type of thing that draws people into these bubble assets. So to come back to your question, do I see any parallels between that and today? I think everyone has probably spotted quite a few. We have very abundant money in the economy. We have app-based trading. these innovations that have, I don't want to say eliminated commissions, but made it seem as though commissions have been eliminated. We have clearly a lot of speculation, a lot of people seeing their friends get rich, and we have a lot of cash, very low interest rates, stimulus checks, and so on. What I would say about the environment today is that it's exactly the type of environment where we would expect to see bubbles develop.
Okay, thank you very much. Well, that's really, really helpful. So let's think about maybe some of the sort of risk management implications here of this, and some of the risks posed for the financial markets. So turning to Sonia, should banks be concerned about what's been happening in financial markets over this past year, Sonia? Are there systemic risk implications here for the stability of the financial system? Yeah, I think you're on mute, Sonia.
Yeah. You're right about that. So, that's an interesting question, and yes, banks certainly should be concerned for a whole host of reasons, and I think there are many impacts and ways that we can think about how this might impact the banks, and the first, and there's multiple, but one of the obvious ways is the banks themselves and their own activities operating in these environments, their own proprietary capital markets and trading activities that are clearly impacted by the volatility and uncertainty that they're facing, and the impacts to that and capital and liquidity. Clearly client impacts, both institutional and retail. One of the things maybe we'll talk about is the huge divergence here in winners and losers, and that makes this situation have some unique characteristics, given, and I'm sure my colleagues Jamie and Will have lots of parallels to prior ones, but there are specific industry sectors and socioeconomic groups that are clearly disproportionately impacted both on the upside and the downside here. So we're seeing huge divergence in terms of winners and losers. And I think there are clear concerns around the housing market in many circumstances. So, we've seen similar levels of volatility in previous crises for sure. But I think there are some structural differences that maybe impact and influence the outcomes and clearly drive the booming equity markets. And, that's the unprecedented fiscal stimulus across all of the developed economies, which I think has resulted in a markedly different credit situation that we will have seen in past crises, and the averting, maybe delaying, who knows at this stage, meaningful credit losses. And I think that has sort of bolstered the financial system, at least in the near to medium term. I think also financial institutions were far better positioned for this crisis following the 2008, which many of the policies and the regulation that was put in place related to capital and liquidity clearly have helped in this situation. Things like the counter-cyclical buffer in particular, which I suspect Rebecca might talk about a little bit. But I think when you take into account the massive QE, both the fiscal and monetary policy, it has certainly shaped the financial market outcome in this situation and the economic outcome. So I think the interesting thing from here is the subject that we're going to get into, which is the inflationary side of this, and where that leads us, and how move forward in that regard. So I think there are a lot of, there's a lot of cross currents here. And I think how the financial system comes out of this is going to be very much, has been so far driven by regulators and central banks. I think that's been the driving force. And I think that will continue to be the driving force here. But I don't think the story is yet fully understood and fully told. And I think we're seeing new complexity come into this equation. We're, as we see COVID, I think a lot of people had started talking about it's gone and it's over and we're out of this and we're into a new stage. I think we're finding that we're not necessarily into a new, we're into a different stage, but we're not out of it. And if we look at what's happening in the US today, or even in the UK, there are going to be continued economic implications. And I think the other factor that we probably should talk about is the whole supply chain impact of all of this that is still emerging, I think, in many ways. So yes, there's lots of reasons for the financial sector to be concerned as we move forward, but I think the financial sector has largely been protected by all the fiscal and monetary stimulus to date.
Yeah, thank you, Sonia. Yes, it'll be interesting to see just what happens when the stimulus tap is turned off, and when the tide goes out, and we'll see then maybe some of the problems that the financial system is going to face. So,
one thing I'll say on that, John, is it's interesting when the U.S. banks just announced their results, and they had lots of success on M&A and all sorts of capital markets. But if you looked at their retail numbers and the lack of lending and credit activity, I think that was a surprise to many, and an indication of how much cash, how much saving is sitting there, and the impact of people not having had anything to spend money on for the past 18 months, other than, as I think Will has highlighted, the opportunity to play around in the market and crypto and all these weird and wonderful opportunities that they've found to occupy themselves.
Yeah. So interesting, and this takes on to Rebecca in terms of the housing market. And so, we've had the fiscal stimulus, we've got super low interest rates. Is there anything that central banks should be doing to rein in financial markets or even housing market speculation? So you look at house prices in Ireland, UK, in Canada, US at the minute, they're all on an upwards trajectory. So what tools do central banks have at their disposal to deal with surging asset prices?
Well, I think the first thing to bear in mind is that most central banks have a mandate towards inflation, and that's what they look to. And when they talk about inflation, they're not talking about inflation in one specific asset class. You're talking about consumer price inflation, essentially, so a basket of goods that people consume. And it's interesting that the ECB has recently said that they want to include housing in their measure of consumer prices. So they want to take housing more into consideration than they did before. But most central banks actually already include that in most CPIs, the PCE inflation measure, for instance, in the US, that includes a measure of housing. It has a certain weighting within the basket. So when central banks think about what's going on in financial markets, they usually think about it in terms of the effect on inflation, the effect on the broader macro economy, and that often essentially comes down to leverage. So are asset prices being driven by an underlying leverage, or is it sort of a cash-based bubble? Because when asset prices reverse that were being driven by leverage, then you end up with problems in your financial system. People have problems repaying loans, and suddenly you have difficulty with credit flowing to the real economy, to businesses, and therefore you have this circle of kind of slowing economic growth, lower employment, and so on. So in that sense, although I'm sure will be able to point out many exceptions, by and large, stock market bubbles are deemed to have less of an underlying leverage problem than housing market bubbles would. That's not a uniform situation, but it's, you know, in general, we often think of that. So it's often that central banks might be more interested in what's going on in terms of the housing market than in terms of the stock market as a result. So then the question is, what can they do? And I guess, you know, the traditional tools of a central bank are really interest rates. And we think of interest rates, raising interest rates to try and counter what's going on. But people talk about interest rates as well as getting into all the cracks. So you know, the central bank moves the interest rate at the short end, it works its way out the term structure, works its way across the financial system, across all kind of credit activity that's going on in the system. But at the same time, you could also think of it as basically affecting the groundwater of the economy, right? So the interest rates affect underlying economic activity, unemployment, and so on. And if you have a housing market bubble where house prices, as they did in the Republic of Ireland before the global financial crisis, were rising 10, 15, 20% per year, year on year, house price increases. And a central bank, what is the central bank going to do there? If it raises interest rates by 1 or 2%, it's not going to have a big impact on the housing market in general. If it starts raising interest rates by 10%, it's going to absolutely hammer the real economy, and unemployment is really going to rocket and so on. So in a way, the interest rate is really, as a tool for a central bank to deal with an asset bubble in a specific sector, is really a very blunt instrument. And that's why after the global financial crisis, we came around to these macroprudential policies and these ideas of, and a lot of these are housing market related. So policies that sort of maybe limit the maximum loan to value ratio that banks can give mortgage customers, or maximum debt repayments. So the percentage of your monthly income that goes on repaying your mortgage debt or something like that. And so central banks have been given these macroprudential powers by and large, and these are the ways that I guess we would see central banks, I think, in the future attempting to limit bubbles within the housing market. The amount of empirical evidence for their success is still being, you know, increased over time. So how successful that's going to be is going to be interesting. And I do think we're going to see a lot of it probably in the Euro area as well, where, you know, really you have a heterogeneous set of economies between Western Europe and Eastern Europe in particular, but North and South and so on. The economic cycles are really heterogeneous, but you have a homogeneous monetary policy. And so you're going to find that housing markets are going to be on different cycles in different countries. And this was the case, for instance, for Germany before COVID. House prices were rising quite rapidly in Germany. And the sense was, well, you have to deal with that with macroprudential policy. So it's going to be interesting to see how that works out.
Okay, so thank you very much, Rebecca. So can I just encourage people to continue filling your questions in through the Q&A function. I've got a few here that I'm going to feed into this next segment. So next segment, we're going to be thinking about cryptocurrencies in particular. Again, you know, what's been going on in the cryptocurrency market, the implications of that for financial institutions, and the whole role of central banks in this whole area of cryptocurrencies. So I'm going to start with Will. And I'm going to ask Will a couple of questions about cryptocurrencies. First question, Will, is, are cryptocurrencies money?
Yeah, thanks, John. Are cryptocurrencies money? This is a good question. It's almost a philosophical question. In financial economics, we think of money as defined by fulfilling several functions. But to really simplify it, to sort of bring it down to its most important core, money is money if you can use it to buy things, if it's a medium of exchange. And you can almost think of it as a spectrum. So all money can be used to buy some things, but not all things. So the question of whether cryptocurrencies are money or not is a question of whether you can use them to buy things, or the extent to which you can use a cryptocurrency to buy things. So a few of them, maybe you could call themselves money. Bitcoin can be used to buy some things. It's very awkward and not actually done very often anymore, but it can be done. There are places all over the world that will accept Bitcoin as money. Ethereum, you know, it's not so much used to buy and sell goods in the real economy, but it's used for other purposes that could sort of maybe give it a little bit of a claim to be treated as money. I think that the cryptocurrency with the strongest claim is actually Monero, because it's the one most frequently used to buy illegal goods and services and pay ransomware ransoms, because it's so difficult to trace. So those three, you could say to an extent, are money, or are somewhere along the spectrum of money. But there are, I think, 11,000 cryptocurrencies out there. Most of them would be a zero on the spectrum. You can't use them to buy anything. And just because you call it a currency, it doesn't make it money in any real sense of the word.
What explains what's been happening in the cryptocurrency market? So we've seen the price of Bitcoin soar up to what, 60,000 plus US dollars. It's down at roughly 30,000 US dollars today. It's done something similar in the past. And, you know, so what explains what we've been seeing? And just to feed in a question here from the audience, you know, what's the role of Elon Musk in all of this? Is he really driving this market?
Okay, so what's causing this latest round of a crypto boom? I'm going to answer on what I think is the balance of probabilities explanation, because it happens in real time, and we're piecing it together still based on imperfect information. The most likely explanation to me is that throughout 2020, the second half of 2020, the price of Bitcoin started rising again. And this is very often, or almost always, what starts a bubble is a rise in the value of an asset caused by something other than new investors coming in. And it wasn't clear at the time what was causing that rise in the price of Bitcoin, but by far the most likely candidate is the minting of stablecoins, and these stablecoins being minted in billions of dollars and being used to collateralize highly leveraged bets on the price of Bitcoin that allowed the price of Bitcoin to be, in a sense, manipulated or controlled. And this led to the price of Bitcoin rising 700–800% by the end of 2020. Now, at that point, the financial media started to take interest, and as we may be aware, a lot of what financial journalists do is look at a change in the price of something and then come up with a story that seeks to explain it, but which often has no relevance at all to what's actually causing it. And these journalists, who were typically used to working in very liquid and transparent markets, assumed that it has some kind of fundamentals-based explanation, that people were becoming more excited about Bitcoin, that the technology was improving, or that it had, you know, certain qualities as an investment, as a good hedge, for example. And these were the stories that they wrote. So it gained a huge amount of attention, and this is when retail investors start coming in. This is when, you know, my mum starts texting me asking, should I buy Bitcoin? And this is when you see, you know, to use harder evidence, this is when you see more Coinbase accounts start to open, and so on. But it's after this initial rise that has been sparked by the stablecoin industry. So that's what I think has started this, and it seems to have almost run its course at this point. But it's still attracting quite a lot of attention. The other question from the audience is, what's the role of Elon Musk in this? And I think the question was, let's see, is it positive or negative?
Yeah.
Now, it depends what you mean by positive or negative. The way crypto as an investment works is that money from, or cash from late adopters pays out early adopters. So if you're holding crypto, Elon Musk's effect on your holdings is going to be good because he attracts a lot of attention. A lot of people follow what he does, and if it gets more people talking about Bitcoin, even sometimes when it's not necessarily actively positive what he's saying about it, keeping it in the news tends to be good for people that hold Bitcoin. If you mean the cryptocurrency space in terms of its long-term future and what Elon Musk's involvement means for that, I'm not sure if it really means anything. It's very hard to say what the future of cryptocurrency as a space is going to be because everything is overwhelmed by the use of cryptocurrencies for speculation. I just almost never see anyone talk about any other use for them. So it's very difficult to say, and I guess he won't have much impact on that at all.
Mm-hmm. Okay, so thank you for that. Well, so given what Will has said then, Jamie, should investors have cryptocurrencies in their portfolio? And also then just bringing your financial history perspective to this, have we seen this sort of speculative craze before that we're seeing in cryptocurrencies?
It's weird to bring the financial history perspective when I'm talking to you and Will as the experts on financial history. I learned all my stuff from you two. But in terms of cryptocurrency, I feel like it's kind of a boring answer, but I think it's the right answer. It depends on each kind of individual investor's situation. And I would say broadly that just with something new like this, even though I do think with something like Bitcoin, with the amount of institutional buying that's starting to take place and kind of institutional interest, that it provides some more kind of stability and longevity to the asset. There's still a bunch of scammy, fraudulent ICOs and kind of less than favorable coins. But as a whole, I think that it should be something that an investor should only have in their portfolio if they have done research and truly understand what they're actually investing in, rather than just holding it because they saw a lot of people make a lot of money in it before they got in. And if it is going to be a part of your portfolio, I think it should be a small allocation that you're willing to lose. Like if it's only put in what you're willing to lose, so that if it does kind of just go completely south, that it doesn't tank your whole portfolio overall. I think in general, in terms of speculative crazes in history, again, you guys are the expert, but I do think that there are kind of cycles like this where there can still be viable long-term companies, or in this case, coins, but there is still a wave of kind of fraud and imitation around that, even if it's related to the same overall new technology or what have you. And so the crash can kind of wash out the crap basically, and then the strong companies that are left standing are the ones that can go on and remain viable. So I think it's just a matter of making sure that you're doing research to find what companies in a certain new exciting space are actually fundamentally viable, and whether or not they're just kind of attached to the narrative hype cycle. So like the tech bubble being a good example of the companies that survived that and came out, or ones that continued to go on and be successful, but a lot of companies that were not fundamentally sound were wiped out in the crash.
Mm-hmm. So let me, and maybe this is Jamie or Will, you can jump in this. It's maybe going back to a comment that you made, Will. You know, cryptocurrencies, it almost sounded like a Ponzi scheme you were explaining, but have I picked you up correctly there?
Yeah, well, the best way I can put it is that it's not a Ponzi scheme, but it works like one.
Okay.
A Ponzi scheme needs to have someone in charge controlling it. Crypto doesn't have that. It's operating on its own. Oh, well, someone started it anonymously, but there's no evidence that they had anything other than sincere intentions, and there's no evidence that they've made any money from having started it. for something to be a Ponzi scheme, that can't be the case. It needs to be someone actively running it. But what I said, I think the comment you've picked up on is that the returns come from late adopters paying out early adopters, and that's just absolutely the case. That it's not wealth producing. It's not. You don't get rents. You don't get company profits. You only earn money from Bitcoin if more lead adopters come in and bid up the price, and you're able to cash out by selling to them.
Okay, so thank you, Will, and thank you, Jimmy. So, Sonia, one of the things that we've noticed over the past number of months, financial institutions and asset management companies investing in cryptocurrencies. What are the dangers of that, and what do regulators need to do to address the risk potentially arising from cryptocurrencies? Sorry, you're on. You need to hit unmute again, Sonia. Sorry.
Okay, one of these, once we're done with needing to use web calls, I'll have figured it out. So I just wanted to, before I answer that, and I will of course answer it, both Jamie and Will sort of talked about this notion of, understanding what you're investing in and doing this research. It's not obvious that much of that is happening in the marketplace, particularly with the retail investors that are getting into this. And to me, it feels like it's entirely driven by this notion of fear of missing out. This is sort of that classic, and you're the experts on bubbles, but to me, this just feels so much like it's in that category. And the number of people that I've heard say, oh, well, I need to get some because who knows, they have no clue, like people who have no clue what they're buying. And I think what's even interesting is how difficult it has been to buy. And so hence, you get to your question about banks and asset managers, et cetera. They're creating an opportunity for people to actually enter this market more easily. So I think that creates a bit of an interesting dynamic here, because so many of the reasons that it's all been created around the privacy and leaving the financial infrastructure out of it is now being brought into play. So I think that's all going to participate in reshaping how this evolves. And so, you've got this activity going on with private companies, whether we're like right off the top, there's no reasons for banks to want that on their balance sheet. It's using capital which can otherwise be better used. So that part's sort of easy to kick. I just don't see the value or the benefit in banks doing much in that space. The more interesting thing is what's going on with the CBDCs and stable coins and the role of the tech companies versus the central bank. And, I think that's sort of a bit of a battle still to be played out. In the end, I think that, central banks are going to absolutely feel the nest. And they're all working at this in different ways. I think the central banks, and maybe Rebecca might comment on this, I don't know how much they're collaborating because they're all coming out with different messages from what I can see. Some are going more aggressively and starting down the path. Others are, like the Canadian in Canada. Well, we're doing our research, but we're going to sit back and wait. So there's a lot of different things happening there. In my view, we need some collaboration on that front, and they need to, come together with some sort of more consistent plan. But I would say that, there's concern for financial institutions in this whole thing in terms of instability that may get created when you disintermediate. Like there is a lot of space for disintermediation of the banking sector. And there are many who would argue that that's okay, that's fine. I'm not so sure, and maybe that's just because, once a banker, always a banker, and I have a soft spot for it. But I think there's the room and the opportunity for instability to be created by the void that exists there. All the obvious aspects that brings about it. I think that we should all be somewhat fearful around going too actively down that path without having other sources to really manage that. One of the benefits of the banking system is the regulation that takes place. The minute you start disentangling all of this, you get into huge policy and regulatory challenges, and ability to control and manage the development in this space. And I think you end up with a some might argue that the banks don't always work in favor of the underbanked or the underable, and that crypto will allow them in. I don't think in the long term that's going to necessarily materialize in that way for the benefit of those who think it might help out in that regard. So I think that there's still a lot to be done in this space. I don't think it's going away. I don't think it's going to disappear. But I think it's going. There's a lot more evolving to do, and I do think the central banks. This is one place that they are going to and will need to play a really key role in how they shape it. And I'd be cautious there too around, do they want to deal directly with all the investors and the purchasers? How do we keep the banking system within that? Maybe you broaden it somehow. And then on the asset manager side of things, I think many asset managers, again, they're just they see the momentum. They see an opportunity to put out a fund. There's little downside if you're an asset manager to staying, or at least on the surface, there's little downside to participating, and they want to be part of the momentum here, as opposed to I don't think there's great fundamental belief or buy-in or strategic alignment in any way in that regard. So I do think that I think it's wrought with challenges moving forward. And I think in the end, as in many of these cases, retail investors who come in at the tail end have the greatest to lose in a number of these scenarios.
So thank you, Sonia. So you've teed up Rebecca beautifully here. So if we think of central banks, Rebecca, we think of them having a monopoly of the note issue, the monopoly of the currency. Now that's not always been the case, because in the United States, in UK, several European economies, before there were central banks, you had competing banks issuing their own money. But eventually, central banks have a monopoly of the currency. So what are central banks doing in response to the rise of cryptocurrency? Are they going to develop their own digital currencies? And one of the questions that's been fed into the chat on this as well is, are they going to adopt them to facilitate international payments, etc.? So maybe if you could just give us your views on those things.
Sure. Well, I think you brought up the idea of free banking and banks issuing their own notes, and the fact that ultimately the central bank then gained the monopoly on it. And my guess is that ultimately central banks are going to gain the monopoly on digital currencies as well. I would draw a distinction. I agree with, by the way, Sonia really covered a lot of my points, but I would draw a distinction between, cryptocurrencies like Bitcoin and stablecoin. Stablecoins are something that is essentially backed one for one by hard currency itself by, say, well, $1 US equals 1 token. We're thinking about things there like Facebook's DM and like assets like that. Now, cryptocurrencies like Bitcoin, central banks, I think in general, for instance, the Bank for International Settlements recently in Basel, they basically came out and said this is just a speculative asset. They don't really see it as a money alternative, something that's going to interfere with the cash that's issued by central banks. Stable coins, I think, are a different issue, and they're something that central banks see as a potential competitor, I think, to the money that they issue, to the currency that they issue. And to a large extent, this comes down to something that's similar to a consumer protection issue. So if Facebook is backing, for instance, a lot of what's going on in terms of payments, if I hold a lot of DM with Facebook and then Facebook goes bankrupt, what's going to happen? This is a consumer protection issue. Like if Facebook was large enough, if that was a large enough currency across enough countries, you could have a massive economic impact of Facebook going bankrupt. And ultimately policymakers, central bankers, but also I think politicians and policymakers more generally are not going to be happy about that. They're not going to be comfortable with that. And so ultimately, I think, you know, central banks are going to step in and legislation is going to be passed and central banks are going to have their own digital currencies. And you brought up the idea of note issuing central bank, or banks issuing their own notes. And that's a really good comparison, this idea of private money essentially, which we had in the past, and which essentially the idea there was that, you know, a bank issues a note and it says it's like worth $10 or £10 or something like this. But then when it comes to actually transacting, that doesn't necessarily mean anything. It depends on people's perceptions of the health of that bank specifically. And this causes a lot of difficulties in terms of transactions. So, you know, you have haggling over how many notes you're willing to take, you know, for a product, and it reduces the amount of economic activity and trades going on in the economy. And ultimately, when a bank goes bust or something like this, someone is left holding those notes and someone loses. And generally speaking, it's going to be, you can call them the idiots, or you can say it's the person with the least information, which is just normal people on the street. It's just consumers. And calling them idiots is a bit harsh in that instance, right? And this is why we have, for instance, deposit insurance today, so that people who are the least informed in society don't lose all their money when a bank crashes. And ultimately, if Facebook crashed, you'd have to say that you'd expect the state to step in and probably back these people up. And because of that, they're either going to regulate Facebook so that they're essentially part of the financial system, and they essentially have to meet everything that like a regular bank that holds deposits has to do, or they're going to step in and say, well, we're going to issue our own digital currency. And as they did back when they got rid of private banknotes in the past, like basically just tax them out of existence or something else in order to do that. So my guess is that ultimately you're going to see central bank digital currencies. And that, you know, this is something, obviously the private sector is probably going to be more innovative. They're already ahead of central banks at the moment, but central banks are also just going to be very careful that when they do bring something out and they do institute something, that they don't make a mistake, that they don't have to change it. So they're going to be slow at doing this. They're not like an entrepreneur where you can just go into the market, try something, and if it doesn't work well, you just start again. Central banks aren't going to want to do that. So they're going to want to come in with something that they're very confident is going to work. And Sonia's point about international coordination, I think, is a good one. It's not clear that initially that this is going to help a lot with foreign exchange transactions, because it's not clear that the payment systems between jurisdictions for central bank digital currencies is how that's going to operate. But I do think that the Bank for International Settlements, as I mentioned before, they're attempting to play a coordination role, and I'd say that ultimately things will come towards something that is in some way harmonized across countries, but I'm not sure exactly how.
Thank you, Rebecca. It's interesting that there's, you know, 3 countries that I know of in the world that still private banks issue their own notes. One's Scotland, one's Northern Ireland, and the other's Hong Kong. But of course, they're not really private note issues. They're backed up by central bank money. So before we leave the cryptocurrency question, there's a question that has come up in the chat that I'm going to ask Will to talk about, because it goes back to something he said that, you know, so there's a lot of people, maybe you could say, manipulating the market, using social media to pump cryptocurrency and then selling out after that. And, you know, does that come close to being a Ponzi scheme, Will?
Yes, so this is a good question. As I say, a lot of this stuff, you think in balance of probabilities, it's not very transparent. We don't know what's going on in a lot of these shady organizations, but some of them look a lot like Ponzi schemes to me. They're making promises that are clearly too good to be true. They don't have an obvious business model, and they're very, very aggressively raising funds. So yeah, a lot of all types of fraud going on in the crypto space, and Ponzi schemes are very likely to be one of those types of fraud.
Will has a death wish with the way he's talking. The Bitcoin fanatics are going to come after him.
Well, it could be worse, Jimmy. He at least he's not pumping Bitcoin, you know, and hoping that you know, people are going to be trading off the back of that. But yes, there's almost this cult-like following that Bitcoin has, and anyone who speaks out against Bitcoin or some other cryptocurrencies, they can be attacked on social media and other various things. Okay, so let's go into our final segment this afternoon. We're going to be thinking about the pandemic and, you know, the monetary and fiscal stimulus that's come along with the pandemic that's maybe fed into the bubble that we've seen. So I'm going to start with Jamie here. So Jamie, particularly in the US, we're witnessing what I would say is unprecedented monetary policy and fiscal stimulus because of the pandemic. To what extent have these distorted financial markets and kept them artificially inflated?
Well, in my 24 short years on Earth, it's certainly the first time that I've received $2,000 from the government just sending out checks. So that was nice. And I think that broadly, certainly, I guess, distorted markets to the extent that you could kind of see when these checks are going out, what these meme stocks were doing, then, you know, in a slight delay as people received their money and then started putting that into the market. I don't remember the exact percentages, but I remember CNBC reported that something like over 50% of people in the kind of younger category, like 18 to 24 or something, said that they were going to put the majority of their stimulus checks into the stock market. And so it certainly was the fuel for a lot of these kind of mini bubbles and things like meme stocks, NFTs, crypto, et cetera. And then from a monetary policy standpoint, I'm certainly not the expert on this Zoom panel, but I would say that definitely the continuing suppression of rates and keeping them low, and the Fed's kind of purchasing policy has enabled the markets and kind of expensive growth stocks to continue rallying as people are kind of, what's the acronym? TINA was the popular acronym earlier in the pandemic, of there is no alternative basically except to owning equities and expensive tech equities at that. But now it seems like the market is even more prone to hanging on the Fed's every word than it has been in the past, because previously it was no rate hikes until I believe 2023, and now they're signaling there might be 2. And so it's just kind of this yin and yang or flip-flop where value stocks are doing well, but then after the Fed's meeting in May, then everything inverted, and then tech started rallying again. And so it's just kind of this monetary policy, now that we've gone down this road of unprecedented monetary policy, now it's kind of, it'll be interesting to see how we kind of detransition from that, because now the markets are so wed to this and kind of starting to consider it the norm, that trying to untangle everything might be fairly complicated.
Yeah, so as you say, the unprecedented monetary policy that's now no longer unprecedented, because we've been seeing it for 13, 14 years, and in the case of Japan, even longer. So, Rebecca, just thinking here of the stimulus packages and inflation. Okay, do you expect there to be significant inflation as a result of this stimulus package, whether that be in Europe or in North America?
Well, certainly we're seeing high inflation in the US recently, as Jamie was talking about. And a lot of what we've seen, you know, when we saw inflation start to rise at the start of the year, there was a lot of discussion about base effects, which basically means that we're comparing a period this year to a period last year when inflation was extremely low last year. And that's what has a tendency to push up inflation, the inflation measure this year. And that was what we were seeing at the start of the year, that inflation, underlying inflation was rising, but these base effects were also pushing up inflation. But the most recent inflation figures, particularly in the US, the base effect is actually reversed and would have the tendency to drag down the inflation rate overall. And yet inflation has been higher than it has been, you know, in the recent past. So, so certainly we're seeing something driving inflation, and you know, it looks from the sectors that are the categories within inflation that are having the biggest contribution to inflation at the moment. Things like transportation, motor fuel, and other transportation services really are a large part of what's driving it. And these are all related to people getting stimulus checks and maybe buying a car, for instance, with it, and B, people going back to work, using you know, increase in demand for energy, and this passing through to motor fuel prices and to other transportation services prices. And then the other thing that's driving it is shelter, is housing as well, as people sort of are sorting on the basis that maybe they can work from home in the future, and they're sort of buying properties in new and different places and pushing up prices in those regards. So it looks like overall in the US in particular, we're certainly seeing an effect that seems to be related to the stimulus, to the return of confidence after COVID. And I think, you know, you can anticipate seeing this. We are seeing, not to the same extent, but we're seeing inflation picking up again in Europe and in the UK, for instance, as well.
So 500. Sorry, Rebecca. Just if I've understood you correctly, you're saying this is a one-off shock potentially.
Well, at the moment, I think central banks are thinking that it's probably a transitory thing, that it's that it's something related to a pickup in economic activity at the end of COVID, and that we will see the end. You know, it'll play itself out, and they don't necessarily need to respond to this. They're also happy, I think, to let it go. The Fed has recently said it's going to move to average inflation targeting, and this means that it's willing to make up periods of low inflation in the past with higher inflation now and in the future. So they're going to be willing to let inflation rise more than maybe they would have in the past. Indeed, the ECB, even yesterday, they've changed their strategy as well, and now they're saying they're willing to overshoot 2%, which would not have happened before their strategy review came out last month or earlier this month. So I think central banks have sort of, I think it's credible. At least it must have had some impression on people in financial markets to make them feel that central banks are willing to accept slightly higher inflation than maybe they were previously. But I do think that people have tended to say, well, this could be like the 1970s or something, you know, and we'll have this rocketing inflation in countries. And I just don't think that that's credible. So central banks are very different today from what they were in the 1970s. Their independence, they're more independent legally speaking than they were then. And their objectives in terms of price stability are different. In the 1970s, they were supporting incomes policies of governments and so on. And so I think that while the Fed is willing to see inflation in the US in a transitory way be around 5% or something like that this month, I think if we saw that going on for 6 months or something like that, the Fed will step in. Inflation won't be going up to what we saw in the 1970s. I would be very surprised if that were to happen.
So I can barely remember the 1970s, but inflation in the UK in 1974 was 28%. So you're saying we're not going back to those sorts of levels. You mentioned, Rebecca, the sort of whole question of central bank independence, and one of the questions that's been fed into the panel is around whether extraordinary monetary policy and the pressure coming from government actually undermines the independence of central banks, particularly moving forward.
Yeah, I think this is an interesting one. So this came up around COVID and the COVID response. But really what happened with COVID was that fiscal policy and monetary policy objectives were quite closely aligned, right? So this was something that was very much like a demand shock, really. And the central bank and the fiscal authorities' incentives and interests were very much aligned. And so there's no problem, I think, for a central bank to act in line with the government and with fiscal policy in instances like that. The problem, so I wouldn't take that as a signal that there's something changed or missing or wrong with central bank independence that we didn't have before. And you know, central bank independence is in legislation. It's there in legislation. Central banks are protected in most countries, not everywhere, but in most countries they're protected in that way. So having worked in a central bank, I find these discussions quite strange, that people think that central banks might be affected by political motives in this way. I just see central banks as operating towards their mandate. They're very focused, like the ECB, for instance, is very focused on its price stability mandate. That's what it's pursued through the global financial crisis, especially from the Draghi era onwards, and through the COVID pandemic. And I just don't see them being captured, particularly by politicians.
Yeah, it's interesting just to give the sort of the long run perspective on this. The Bank of England, of course, when it was set up as a private company, but you know, its main mission was to support the government during military emergencies or other emergencies that would crop up. So you can think of major catastrophes, pandemics. These are all things that central banks should be reacting to. It's part of the reason we have central banks in the first place. Okay, so thank you. So Sonia, as we exit the pandemic, and when I say exit the pandemic, we're not quite sure when that's going to be taking place, but we're on track in terms of with the vaccine and the rollout of the vaccine. What do you see as the potential dangers facing the global financial system? Where should we be looking for the next problem, if you like? That's what you do. So
you know, the first thing I would say is, you know, how we ease out of this current crisis remains still a very difficult challenge, and Rebecca and Jamie have touched on some of the points. But you know, the reality is, you ease out too quickly, it's got risks associated with it. You ease out too slowly, you know, it's got risks on the other side. So it's a very difficult balancing act, I think, for you know, for central banks and regulators as we ease out of this. And I think that one of the key things that has to happen post this situation, much like you know, the last crisis, when we put in the capital buffers, we put in, you know, new requirements. There will be new things that get, you know, that we determine we need to put in to protect the system going forward. But I think in terms of the next, I mean, it's abundantly clear to me that climate is an enormous challenge for the economy, for the financial system, for everything and we're seeing it all around us, but we're seeing it in investing as well. You know, I mean, if we want to look to where the next bubbles are, maybe we're in a clean tech bubble already. You know, we've got these massive expectations of money that has to go into, or that's being driven into things related to the environment, but the industry, the business of it hasn't caught up to it. And so I think there's enormous risk there on many fronts, and that's just growing. I mean, if we look to what's going on in this run up to COP26 and the, you know, every nation's battle to be at the front of the line and to have a, you know, the next you know, most ambitious set of plans without anything to kind of support it. And you've got economies like Canada that are very resource-based economies that, you know, it's a real challenge to achieve that. So I think that's just, for all of us, just a real collective big challenge that we face. I think one of the things we've seen with this pandemic is the interconnectivity of risk. And so, and I think we've always understood that, but I don't think we've experienced it in quite the way as we did through this crisis, where we effectively saw our first global shutdown. And so in a way, we've kind of had a trial run around this, and you know, and we got to position ourselves, and I think most economies came out of it as well as one could have come out of it. But you know, you have to put, the human lives, the human aspect first, but we're going to be living with the economic impact of this for a long, rightly so, but we're going to be living with the economic impact of this for a long time. I think these social issues are not, are emerging in many different ways, and they're emerging in like this whole crypto thing. Some of these, the meme stuff. There's and I guess the sort of the common term for it is mass democratization. There are it's not that it's a bad thing that retail investors have better access, but when you combine that with social media, when you combine that with all of the misinformation that takes place, when you combine that with the speed at which things can happen, those are all those are concoctions for massive risk, massive crisis. So I think I'm starting to sound like Will already in terms of the doomsday. But sorry, you've influenced me. We've got cyber and all the components of that. So we've got a lot of risk out there. We've got a lot of misinformation. We've got social media causing challenges, disintermediation everywhere. And so at the end of the day, I've given you all the problems, from the financial sector, this emphasis on operational resilience, I think is what we've got. It's the best tool we have right now in terms of you gotta keep your powder clean. You gotta stay, you've got to be a strong, stable organization because you have to be prepared for big risks coming quickly, and just being able to manage that, and just the interrelationship between notwithstanding the independence of central banks, but I think it's naive to not think that industry, central banks, and government, when there are big crises or the potential for big crises, shouldn't act in a way that supports the greater ecosystem. And so and I like the way that Rebecca described it. I don't think it's lack of independence, but it would be naive and quite silly of us to not have those mechanisms working in tandem in some way to help you manage the risk. So, I could probably go on for indefinitely on this.
Yeah, so I think the points you make there are excellent, because as a society, we've experienced these huge shocks and risks in the past. And sort of our collective learning is that, we have to build up resilience towards these types of things that have, occurred in the past. And maybe some of our preparedness hasn't been so great this time around in terms of, in terms of dealing with pandemics. But certainly we have seen central banks and treasuries and governments kick in when they've needed to. So that takes me I want to segue, because there's one other thing that Sonia talked about, and that was to do with climate change and then investment in green technology companies. And so one of the questions in the Q&A is around exchange traded funds, so who've experienced rapid growth and heading for another record-breaking year. And there's a huge growth in particularly green EFTs, and indeed some of the best performing EFTs in the United States and in Europe over the past 12 to 18 months have been green EFTs. So is this another potential bubble along the lines of things that we've seen in the past? So I don't know if Jamie or Will want to come in on that question.
Yeah,
I'm happy to. Okay, you're gonna go for it.
I have an opinion, and I think Jamie might have a different opinion. So that the point of ethical investment is that you prefer to invest in stocks that are more ethical, and that's going to drive up the price of stocks deemed to be more ethical relative to all other stocks. So if you look at clean energy ETFs and they seem really, really expensive, maybe it's not going to last, maybe it's narrative driven, maybe it's going to crash, but it's also ethical investment working as intended. This is what happens when people are investing in something, even if it's low return, because they have an ethical reason to do so. So I would find that, I have sort of gone on record saying, I think that Tesla was in a bubble. I think the cryptocurrencies are in a bubble, but I don't think I would ever be able to say definitively that I think clean energy is in a bubble, because these two effects are so hard to distinguish. Jamie?
Jamie, do you want to come in on this point?
So I think so. At O'Shaughnessy Asset Management, the firm that I work for, we've done research, and now, I mean, it's pretty clear that a lot of these kind of top ETFs, the kind of ones with the most assets under management that are related in some way to ESG, mainly the environmental ones, are a little bit murky in their methodology, I would say, for what's included in their funds. So if you look at some of the top carbon-free ETFs or an X fossil fuel ETF, you'll find some really weird top 10 holdings. I can't remember specifics now off the top of my head, but I mean, there are some ESG, specifically environmentally focused ETFs that have like Exxon or something in their top 10 holdings. And you think, the point of your ETF is to not hold these types of funds. So how are you overweight, in some cases, these kind of fossil fuel companies? So I think going back to Sonia's point earlier about asset managers trying to ride the momentum of crypto and launching funds to kind of capitalize on the moment, I think that there's a lot of that within the ESG ETF space, because there's a lot of demand for these thematic ETFs, and not just in ESG, but just thematic ETFs in general. I mean, the ARK funds being another great example of, biotech ETF or whatever you want to call it. Just these innovation ETFs are appealing, and they have great narratives. But so for us, we think that ESG is kind of just a very personal, sort of personal style of investing, and so it should actually be personalized to what the individual investor wants. And so one of the problems with these ETFs is that, and just ETFs in general, is they can't customize to what you actually want. And so we, just talking my book a bit, but we have like a custom indexing platform where one of the beauties of that is, because you own underlying stocks instead of an ETF, you have the ability to granularly customize the exact kind of ESG preferences you want. And so we think going forward, that will be the norm, especially with the wave of acquisitions in the kind of direct indexing space over the last few months in America. But it also kind of helps filter out this problem of holding fossil fuel companies in a supposedly fossil-free ETF. And so I think that there's a lot of kind of virtue signaling on the behalf of some asset managers who probably personally don't believe in ESG or anything, but they can raise a lot of assets by doing so. And they can charge higher expense ratios for a ESG ETF than just a kind of low cost passive beta ETF.
Okay, well, thank you very much.
Can I jump in?
Sonia, yes, please.
I can't resist, but so I think Will's comments about what consumers want is absolutely true. The problem is they're not getting what they want. The issue is they think they're getting something, they're not getting that. And Jamie's touched on this, but in large part, asset managers are relabeling existing and repackaging and putting a nice label on it. And this is not going to get us where we need to get to on this subject. And, and that's where I think, for a future talk, that's where I think the potential bubble comes into play, because there's a whole lot of product that's going up in significant value because it's being billed as something, but it's not what it's being billed as. So at what point in time, I'll leave this with you, Will, to do your work on. At what point in time does that unravel? Because I think it unravels at a point in time. Maybe not soon, because there's so much stimulus, there's so much momentum, but eventually, I think it doesn't deliver.
Thank you, Sonia. So maybe Will, we'll come to you with the last question that I have, and then there's a few other questions for the panel from the chat. So, Will, 100 years ago we had the Spanish flu, and that was then followed by the Roaring Twenties in the US stock market, and then we had the Wall Street crash. So, could we see a post-COVID bubble in the stock market based on what we saw 100 years ago?
Yeah, thanks. So, although I'm an economic historian and I like to look for historical precedents for things, I don't think that COVID is anything like the Spanish flu. I think the experience has been completely different. So, well, the Spanish flu, in terms of mortality and in terms of the age of the people that were affected by it, was possibly maybe 100 times worse than COVID. And the government response was maybe 100 times smaller. So the big impact of the Spanish flu would be, say, demographic. You have like huge amounts of economically active young men killed by it, and this has knock-on effects for the economy. Whereas the economic effect of COVID and the financial effect of COVID is going to be based on how people's behaviors have changed, how the role of the state has changed, and all of the knock-on effects. So could we see a post-COVID bubble? As I said, there are all of the conditions in place that we would expect for financial bubbles, regular financial bubbles. And I imagine that it's going to pop out in a lot of different places. So, electric vehicles, cryptocurrencies, clean energy. If there are skeletons in the closet, they're going to come out. But the overall stock market, I'm not so sure about, because if I was really looking to gamble, really looking for supercharged returns, I don't think I would buy a broad equity index or just invest in these many large cap firms. And to come back to Jamie's point, I'm still not convinced that there is an alternative. That for stocks to become significantly overvalued relative to other assets, something else would need to be undervalued as well. And this is where Jamie should really be answering it, but I don't see any obviously undervalued assets. This is Jamie's job to find these things, I suppose, and it's always going to be more difficult. But I think we'll see quite frequent stock market bubbles. But the 1920s, where you had the whole stock market just swept up in this huge speculative frenzy, I'm not so sure about that. The other thing I would say is that we as in me and yourself, John, wrote an article for MarketWatch about a year ago, where we made this kind of argument where it's like, okay, the stock market could go down or it could go up, but right as of a year ago, it's not obviously in a bubble. And I don't know if you noticed, but the comment section in that article was absolutely brutal on us. We were furious that we would dare to suggest that the stock market wasn't heavily overvalued, that stocks weren't a really bad investment at that time. And that's interesting because it's the opposite of Bitcoin. I'd almost be more worried if, when I talk about Bitcoin and I say it's not a good investment, people get really angry about that. And that's when I think there might be a bubble. If I say, oh, I think stocks might be fairly priced, and people get really angry because they think there's a bubble, that suggests to me that maybe it's not so much a bubble, but very subjective.
Okay, thank you. Well, I hadn't read those comments. I must now go back and read them. Jamie, do you want to come in on the point that Will made?
Well, I would just say that value stocks still have a ways to go to catch up with growth stocks after a 13-year bout of underperformance. So if you're looking for undervalued stocks, that's a good place to start looking.
Okay, well, we've got about 5 minutes before we wrap up, and this question has come in several formats, and it's around the huge levels of government debt and the sustainability of government debt and how we're going to pay down that government debt, whether that be in Canada, United States, Europe, UK, Ireland. So, what are your perspectives on the sustainability of the government debt? Are there any then historical examples of how we've been able to pay down large amounts of government debt? How have we done it in the past? So I don't know who wants to take the question about the sustainability of the government debt. Is that something that worries you? Maybe look at the central banker to start with.
Okay, well, I feel like I would know more about this if I hadn't spent the last 9 months in Switzerland, but I guess well, we're in an extremely low interest rate environment at the moment, and national debt in a number of countries has increased rapidly over the course of COVID, and it hasn't had an impact on the interest rates paid really. So long bond yields have stayed remarkably low throughout that period, and I guess as a central banker, you might take that as a signal that markets understand that this is kind of like a necessary. It's not due to poor management or something like this in the course of on the part of fiscal authorities, but it's a sort of a necessary thing that countries have to do in order to ensure that they have economic growth and repayment capacity in the coming years, and that, like, COVID doesn't just decimate the economy entirely. So from that respect, I guess you would say that the increase in debt has worked okay so far. The question is when interest rates rise in the future, and if that is to happen, what the repayment capacity looks like and the rollover capacity for this debt looks like for countries. I suppose in that regard, you'd have to say that, we've come through a period of extremely low inflation when interest rates have been kept at the zero lower bound, essentially, or in the US, they did rise, but not to really high levels or anything like this. And now we're seeing inflation for the first time in a long time. It comes back to the question before, is that transitory inflation, or are we going to see interest rates start to hike? And if it turns out not to be transitory inflation and interest rates start to go up again, then it'll be interesting to see exactly how this plays out.
Sonia, do you want to come in on that point?
Sure, I completely agree with what Rebecca said. I would add 2 points. One, I think that most developed countries around the world are using this as an opportunity for further spending. So beyond solving COVID, beyond, it's an opportunity to invest in all sorts of other things. So I think that ultimately will, is likely to become a challenge down the road. Right now, everybody has an appetite for it, or most have an appetite for it, but I think we'll see that modify over the next couple of years. And then I think, there's the obvious, and the wealthy will be taxed, and there will be a price to be paid for this. And that will come as soon as it is feasible for governments to do so, and probably not too far off in the distant future. And I think we will see all sorts of interesting ways to try to get at the wealth that has been made over this period of time. Right or wrong, that's where I expect those are sort of the obvious low-hanging fruit in my mind.
Yeah, it's interesting when we look at how, during the 20th century, after First World War, after World War II, how nations, got down to really, really high debt levels. So a little bit of inflation always helps. So my suspicion is that it's more than temporary. It's a little bit of inflation will help get down the debt levels. Economic growth, that was the main way after World War II, that we just grew our economies and we outstripped the debt. And then, as Sonia says, tax, one of the inevitable features of life. So let me thank you all for participating this afternoon, and for all the questions you as an audience have sent in. Let me, on your behalf, thank Sonia, Rebecca, Will, and Jamie. It's been a really interesting conversation. We've covered, lots of topics, from cryptocurrency through to ESG, through to climate change. So listen, thank you to the panelists for everything this afternoon. And let me just wish everyone a great weekend. And if you're in Belfast, please get out onto the beaches, because this is going to end soon. It always ends soon. Like any bubble, it will always burst, this good weather that we're experiencing. So thank you, everyone, and enjoy the rest of your day.